Well, good afternoon. It's Alec Hogg coming to you from London. I hope all is well in your side of the world. Of course, in South Africa, I know the weather's a lot more, a lot more fun than what we're having here at the moment. But London is far better than in Davos, where I've just got back from. Where I kid you not, it was minus 17 degrees. Stu, have you ever been in a minus 17 degrees environment before?
No, like I don't think I was. I think when I was in Davos, it wasn't as cold as it was this year for you guys. So I wouldn't understand the predicament you found yourself in walking the streets there.
No, you can't believe it. Usually it's around minus 6, minus 7, which is bad, but minus 17 is just in a whole new level. It's almost logarithmically it goes, and it just freezes up your face. But anyway, I got some very interesting information coming from Davos, and we'll be applying some of that, in fact, to the portfolio today to make a few changes. But Stu, from your perspective, I know you need to go through the technicals.
Yes, thanks, Alec. Just quickly, if you can please hear us loud and clear, there's a little high five on your dashboard. If you click on that, we know that we're coming through loud and clear. Excellent. So we've got a lot of hands already, Alec, so that was easy. Also, we like to keep it very interactive based. So there's a little questions drop-down menu on the right-hand control panel. If you just slot your questions in there, I'll pick them up as Alec goes through the portfolio itself. I see you've actually got one now, Alec, but you'll touch on that as soon as you get started. But yeah, so that's it from my side on the admin's technical side, Alec.
Perfect. And let's just make sure that I'm not a cardboard cutout and actually try and switch on the, there we go. There's the screen. There I am. Hello, everybody. Back here with the funny, what's it called? Roses in the background. I don't know if that's Yorkshire roses or Lancashire roses. I suppose the one is red and the other one's white, so just in case. Anyway, it is nice to be with you today. And there you can see I do, it's not a cardboard cutout, I do exist, and lovely to be with you. Okay, we got lots to talk about, and I'm sure there's going to be lots of questions, given that we didn't have a December portfolio update. I'm sure that there will be quite a few questions on what's happened to the portfolio, but let's kick it off by going to how it looks at the moment. Whoops, apologies. There we go. The portfolio, as you can see there, top performer, obviously Amazon, which has picked up again in the past month. In fact, since the last time we were with you, since November, Amazon has been quite a good performer. The portfolio generally has done okay, but let me just take you through what's happened in the past 2 months, because we didn't have, as mentioned earlier, a December update. I'll get it right eventually. In this period, in the past month, Amazon went from about $15.80 to $16.70. Very nice. Alphabet was a big mover. It was up $50 to $10.90. Apple was down sharply. You might recall that when we came to you last time, it was ahead of Apple releasing financial results that the market really didn't like, but it has recovered somewhat from its low point. Tencent is up very strongly. It's up nearly, it's up from 303 Hong Kong dollars to 343 Hong Kong dollars over the past 2 months. Vanguard unchanged. Microsoft has maintained its high level, $107 a share. Berkshire down slightly. Alibaba unchanged. And then Adobe has picked up about $13 a share. So overall, the value, as you can see there at the bottom, portfolio value, we peaked at $390,000 in September. That is from a start of $200,000, remember, in December 2014. That was a real blowout almost, well, in the short term anyway. And then we had the sharp decline, as you can see, from $390,000 to $336,000 in October. And we've clawed our way a little bit better, but still off 11% from the December peak. I think that kind of puts it all into perspective. In the last 4 years, slightly more than 4 years, 50 months to be precise, the portfolio has improved by 73% in US dollar terms. In Rand terms, and this is really interesting, in Rand terms, we at one point in time were going gangbusters because the Rand was falling out of bed, but it's been quite an interesting result, and I'll show you in a moment what's been happening to the Rand recently. But the Rand portfolio from around 2 million Rand is sitting at 4.5 million rand, and that's in the 50 months, and an annualized return of 27%. I did caution and continue to caution that annualized return is unrealistic when international stock markets rise by 7% real. So you add a little bit of inflation. Let's say if you can make 12% on your money over an extended period of time, you're doing incredibly well. We've had Amazon leading the way for us, and some other pretty good returns as well. Microsoft's been quite a good winner too. We haven't had it for that long in the portfolio, as you can see, only just over a year, and it's up 44%. So that's been a good one. And of course, Alphabet, a very good one as well. But the idea of this portfolio was to reduce exposure that South Africans have to Zumanomics. We were very pessimistic about the economic policies of Jacob Zuma. That was before we knew how bad the plundering and the corruption was. But as you can see, when we started on the 5th of December 2014, the rand was 11 rand 27 to the US dollar. It is now at 13.62. But in between, it's been a lot worse than 13.62. And generally speaking, the rand's decline since September, the rand portfolio's decline has been slightly higher than the dollar decline. And that is as a result of a firming of the rand over that period of time. Individual performances, there you can see them in a tabular form. Very, very indebted to, or very grateful to Amazon for the incredible performance that that's put in for this portfolio. And this is the reason why I want you to just stop for a minute and take a bit of a deep breath, and let's just talk this one through. If you have a look back there to around November 2017, remember the big change in South Africa occurred on the 18th of December 2017. That was when the ANC elective conference decided by 179 votes to elect Cyril Ramaphosa as its next president rather than continuing with a Zuma dynasty. When you look back today, had the Zuma dynasty been implemented, in other words, Jacob Zuma's preferred candidate, his ex-wife, been elected, we might be looking at a rand which would have reflected what the Turkish lira has done. And there you'd be talking between 25 and 30 to the US dollar at the moment. So there is still, it's very difficult to overestimate the relevance or the importance of what happened on the 18th of December. It's become infra dig now for people to take a swipe at Ramaphosa saying, well, what have you done and how much of the promise have you delivered, etc. The reality in South Africa is that the markets are telling us there was a Ramaphoria, there was an exaggeration, and you can see that with the rand improving from around 14.5 ahead of the elective conference down to 11.5 thereafter. So a very, very strong surge in the value of South Africa's share price. But subsequent to that, and it was unrealistic, you can't improve by 25% overnight and expect that anybody can actually fulfill the promise that you're giving them. Then you could see the rand depreciated. It wasn't just the end of Ramaphoria which did it. It was also international tensions. South Africa being an open economy, very exposed to the trade war between the US and China, very exposed to turbulence in the global economy. Because if economic growth around the world is to decline, South Africa gets, well, they get sniffles elsewhere. South Africa gets pneumonia. And that's the reality of it. But then it peaked out after the stock market meltdown in September 2018. And you can see there that subsequent to that, where the rand was trading at worse than 15 to the US dollar, it's now around about 13.5. And it's in the right direction if you're wanting to buy the country long term. So the message is getting through with all the commissions of inquiry, with the transparency that is happening, that the Ramaphosa administration is determined to address corruption in South Africa. It's also determined to attract investment. We heard from Cyril in Davos that $20 billion of investment was confirmed for last year. And in fact, South Africa was one of the few countries on the continent that had a substantial increase in gross domestic fixed investment last year. It was a 400% increase. It's not surprising given that nobody really wanted to put money into South Africa at the time that Zuma was running the place, and you would have had that immediate rebound with someone, anyone really, who wasn't Zuma. But the fact that Ramaphosa came in gave a lot of confidence to long-term investors, and we're now starting to see it in the value of the rand. So very interesting when you have a look at the rand's performance over the past few months, particularly during another turbulent time. What does this mean? Well, I'd anticipate that trend would continue. So as a consequence, we're going to have to look for outperforming from the portfolio in US dollars to offset the strengthening of the rand. Really, if you then step back a little bit more, you've got to be saying to yourself, we've had a fantastic run in being outside of South Africa and participating in the tech bull. But if you had 100% of your portfolio invested in this portfolio, say, you should be looking to diversify some of that back into South African investments, given that the rand is now starting to get a pretty clear track of appreciation, and that's over the last 4 months. Just to give you, I'm afraid the white doesn't come out too well initially for Alibaba. That's a 3% improvement. Adobe did quite well. It had been struggling in the last month or so, but it's picking up. It's up 14%. Tencent had a really good rebound. It's made a profit of 17%. Well, effectively, what you can see there is everything in the portfolio is in the green, has done well for us. So let's get on to the changes in the portfolio now before we start taking any questions. And the first of those is we've decided to sell Alphabet. We've decided to sell Google. Now, this is a decision was not taken lightly. It was one of the constituents of the portfolio when we began it in December 2014. At the time, we bought into the company at $534 a share. We're selling it now at $1091 per share. A fantastic, phenomenal return, 104% over the 4 years. And thank you very much to Google and Alphabet. So why sell it? What's happened that is bothering you? Maybe I can just put it into perspective. Those of you who haven't had the chance yet to listen to the conversation that Felicity Duncan and I had over the weekend in what we call From the Editor's Desk, where we had a look back at history, which tells you always that when you have dominant players in a particular sector, governments come in and regulate. And both Google and Facebook have been mushrooming in the sector of online advertising. The latest forecasts have it, they're at 50% of the global stake of online advertising, which includes India and China, where they don't have as big a share at all. But it gives you an understanding of how dominant Google and Facebook have become. The forecasts are that they'll get to 75% of online advertising by 2020. Now, that's quite scary. But if you are going to allow this to continue unchecked, then clearly there's not going to be a whole lot of other players in the field left. One of the reasons we bought Adobe was because it makes it possible for the competitors to Alphabet and Facebook to offer similar type of information that these two companies do. And what is the information that they can offer? Well, again, I'm going to point you towards something that you should listen to. I had an interview with Koos Bekker, the chairman of Naspers, who actually unpacked this really well. We were together for about an hour, and we had the recording on for about 35 minutes. He said to me, I'm sure you've got enough there. You can cut it back and edit it. I couldn't cut anything out of it. And and when you listen to that interview, it's up on BizNews, you'll see why. It's really insightful stuff from Koos Bekker. But included in all of this is the fact that Axel Springer, which is a big German publisher, is at the moment suing Google because it says that Google is using its content, which it pays a lot of money for, and not giving money back to it. Now, when you look at what Google makes out of online advertising, the profit margin, in the same way, in fact, it's not quite as high as the profit margin that Facebook makes, which at one point was about 50%, because Facebook doesn't share any of its advertising revenue with the websites. You have to understand that there has to be a kickback somewhere. The antibodies in the system are coming back, and we are starting to see this now. There's a Silicon Valley seer called Jaron Lanier, if you want to read more about him, Lanier. I was invited to an event here in London by Investec where they brought him out. Most unusual looking fellow. He's very large, got an interesting hairstyle, a hairstyle that would go down pretty well in South Africa with braids. Of course, he's not naturally a braid kind of person, but he has the most incredible mind, and he is regarded as the one person who kind of gets what's coming to us. And he's very, very strong at the moment about privacy and about the fact that there has to be a swing back from the fact that Google and Facebook have been able to use data of individuals, you and I, take our data, sell it on, make profit out of it, huge profits, massive profit margins, and not share any of it. It happens always in history. You can think of Standard Oil, John D. Rockefeller, which required a breakup. I think it was into 7 companies. That's how big they were. By what they call it, they call that an antitrust action. You had a similar thing with U.S. Steel, which was the dominant player in the United States, Andrew Carnegie's company. That was broken up by antitrust regulations. Microsoft came under the same pressure a couple of decades ago now, from antitrust, and it had to unbundle quite a lot of its assets. And I think you're going to see this happening in time to Google and Facebook. Why hasn't it happened yet? Well, in the White House in the United States, you have a deeply unpopular president with the public, but a very popular president with business. And it doesn't look, it could happen while Trump is there, but when Trump is no longer there, you can almost underwrite that it will happen. And the next president, whatever polls you want to look at, Trump's popularity has never been lower. Whoever stands against him in 2 years' time, certainly the way things look at the moment, would be not as generous towards businesses like Alphabet and Facebook. The second thing is that we are seeing the Europeans give us an indication of what will occur, and there's just been another $5 billion fine on this time by the French onto Alphabet, which is the holding company of Google. So sure, we're looking a little bit ahead. We're looking at the dark clouds that are gathering. We got rid of Facebook, you might recall, because of the Cambridge Analytica scandal. The share price immediately went up to $200. We sold at $155, but it has subsequently come back, and it's a little bit below at the moment where we sold out at. I do believe, though, that with the storm clouds that are gathering, even though Facebook has got WhatsApp and Instagram and Facebook, and it's looking to merge those 3 into a single brand, even though it has that, the problems that are coming in from the regulators are only going to escalate. So goodbye, Alphabet. It's been fantastic knowing you. You've done very, very well for our portfolio, and we're delighted to have been a part of your journey in the last 4 years. But I'm afraid that the likelihood of, or the risks are now rising substantially, and the likelihood of the stock holding this level or indeed rising from here has got to be relatively small, and certainly on a risk-reward ratio, it isn't a great idea to have Alphabet in your portfolio right now. But Stu, I've been prattling along. Maybe we should take a question.
Thanks, Alec. Just a quick one. When you're on the SA currency, Michael wants to know if there's any concern around the deterioration of Zimbabwe and how that might affect South Africa.
Michael, it's a good question. It appears to be baked in. The rand it's still, if you have a look at it, it's only now getting back to the level it was at ahead of Ramaphosa's election at the elective conference. So it's very much baked into the to the expectations at the moment. If South Africa were to do something really insane, like lend a whole lot of money to Zimbabwe, money that it doesn't have, which sometimes it drives me mad when I see things, fake news just exploding all over Facebook and social media generally, where people make up things and then suddenly everybody believes that they're true. But if this administration were to do something really dumb, then you could see the rand coming under pressure. But for the moment, what's going on in Zim is offset, interestingly enough, by some very good news elsewhere, in particular in Mozambique, where South Africa is showing its true colors through, you might recall, I'm talking from an international perspective. You're sitting in a London dealing room, you look at Mozambique, there's a thing called the tuna bond scandal. $2 billion was raised for Mozambique by Credit Suisse. It is shown that 200 million of that went AWOL into certain bank accounts of people who should not have received it. It was all supposed to go to the people of Mozambique. And that has now exploded into the consciousness of the Western community. And South Africa has played its part by arresting the former finance minister of Mozambique, who was en route through OR Tambo to go and see his girlfriend in Dubai. And as he got off the plane from Mozambique, before he could board the flight to Dubai, he was arrested on the request of the Americans as part of the extradition treaty. So it's all a very interesting development on what South Africans are doing on that side.
Thanks, Alec. Just on Adobe, EJ would like to know, says, could you please elaborate on how Adobe makes its money? I think, could you elaborate on the role of Adobe and how it fits in with your decision to sell Alphabet?
Yeah, that's a really good question. Adobe is best known for software that's been around quite a long time, and it's a software company. Okay, so let's start off with, it's a US software company. It's got PDFs. I think most people use PDFs. They understand how ubiquitous PDFs are in the world. And it's also got design tools as well, which are as ubiquitous in that community as PDFs are for kind of the rest of us. But what is exciting about Adobe is that it has tracking software for publishers. Now, if you start from the basis that in the media industry, and it's a massive industry around the world, you are having the traditional publishers having their lunch eaten by Facebook and Google. The reason they have their lunch eaten is because Facebook and Google can give information on the audience to advertisers, which makes them an irresistible purchase. Also, because they're getting their content for free, they don't have that cost either, whereas publishers do. So really, so they can undercut anything that publishers are trying to provide. So publishers are getting hammered on two bases. They're getting hammered by on the cost basis, because their cost of producing their content is high, whereas of course their competitors is nil. But more than that, they can't give the kind of data to advertisers that Google and Facebook can. The fact that Google and Facebook can do it by what looks to be a very unsustainable way of plundering personal information is beside the point for this argument. What Adobe does through its new suite, its new creative suite, is it gives publishers the ability to start building that kind of information on their audiences, which will then give them something that they can defend themselves against Google and Facebook. So it's whether it works or not for publishers is kind of irrelevant from where Adobe sits. From Adobe's perspective, they've got this very powerful tool that they're offering and that they're selling, which is being picked up. So it's almost like a little bit of a game changer for them. The second thing for Adobe is that they have followed the Microsoft route. Now, if you have a look at Microsoft's improvement in the share price over the past couple of years, it was aligned with a decision at Microsoft to start charging monthly. So they have, if you have a Microsoft product, you can buy it, you can pay annually, but if you want, but it's actually a annuity income stream now, rather than relying on updates that you have to go into the customers must go into the shop or go into the website to buy the new edition, Windows 8, Windows 9, Windows 10, whatever. What they're doing now is Microsoft has gone to that automated revenue, and if you buy, for instance, Microsoft Office, it'll automatically renew, and if there's any updates that come through, you automatically get that, and so on. Adobe has done exactly the same thing. So they've moved away from selling you boxes to having a monthly payment that you make. I know, for instance, we use Adobe Audition for our podcasts, and we buy that every month. $16 goes off my account as a payment for that. Now, that is an incredibly powerful business model, because you are, particularly for a software company, because you are guaranteed of a certain revenue stream. So once people, it's like our BizNews Premium, like all of you guys are on BizNews Premium. When you see that you get such great value out of BizNews Premium, especially in our case with the Wall Street Journal, then, and it only costs you $5 or £5, it just doesn't make sense to ever cancel. And it's a similar thing with these companies as well. That's why you're seeing Adobe as a lovely, lovely long-term bet.
Excellent, thanks, Alec. Just a quick question on the performance of the portfolio. Jorge Peters wants to know, how does it compare to a relevant index fund? I'm not sure if you have that detail, but I'm sure it's a lot higher.
Yeah, it's very easy to see, Peter, because we've got the Vanguard S&P 500 index, and if you let's look at it, let's just see where that where the picture is. There we go. If you look at the Vanguard S&P 500 index, we bought that in 2014 when we started. Now what the S&P 500 index does is it tracks the market generally. So the market, if you had bought into the US market in December 2014 and you put all your money just into the market, so in other words, you track the index, you would to date have made 55%. This portfolio over that period in rands has made 114%. So yes, it has outperformed the market quite substantially. Why? Well, we got lucky. We bought Amazon at $327 a share. So anybody who's bought Amazon at $327 and there's now $16.70, you don't have to be too clever to be able to outperform the market as a result of that. Well, just hope that you don't make stupid mistakes and underperform. It's difficult to have a direct comparison with some of the other stocks in this portfolio. Most of them have outperformed the market, though, the market generally. And certainly Microsoft has, even though it doesn't look like it from this return, because have only had Microsoft for just over a year, whereas the Vanguard is over 4 years. So it gives you that understanding. Alibaba has not outperformed the market. Adobe has in the very short period that we've had it.
Thanks, Alec. Just a follow-up. He wants to know, but why then, wait, I'm just going to read his question. He says, why does Alec always urge investors to use index funds rather than paying management fees? I'm not sure if that came across properly, Alec.
It's a great question. I recommend that I've studied Warren Buffett, and I think he just, when it comes to investing, you got John Bogle who created index fees, the late John Bogle, he died last week actually, who was introduced in fact by Buffett at his annual general meeting this past year, which was lovely. If you go back and listen to the recordings on BizNews, you'll hear him being introduced and the 30,000 people who were there at the AGM giving him a really good cheer, which he deserves. Buffett says he's added hundreds of billions to the value of individuals' portfolio through index funds. And Buffett says for the know-nothing investor, for the average guy, the average Joe, who doesn't have the privilege of being able to read for 2-3 hours every day, as Buffett himself does, and some other people are fortunate enough to do, who isn't in touch with the markets all the time. For the know-nothing investor, the best thing to do is to buy an exchange-traded fund. That's what Warren Buffett says. For, however, the more interested investor. So what we did here with this portfolio, it began on the basis that South Africans are affected by the tyranny of distance. South Africans, generally speaking, are insulated, or have been for many years, from the rest of the world. And as a consequence, most of the investments that South Africans make have been in the JSE. So we kind of know the JSE pretty well, but we haven't really looked outside of it. Just over 4 years ago, Standard Bank Online Share Trading launched WebTrader. You can see the name down the bottom. And what WebTrader did was it gave South African investors the opportunity to invest in the tens of thousands of stocks that are outside of South Africa itself, rather than just the shares that are in the JSE, the 300 odd shares that you can buy on the JSE. Put differently, South Africa's got 0.8% of global GDP. And when you're buying on the on the JSE, although you have got stocks who are international, you just keep that in context. The other 99% of the world is outside of the borders of South Africa. So what Standard Bank was doing was just saying, if you want to look after your investments properly, look outside of the country, you should be diversifying. Why are you putting all of your eggs into a basket, which is really 1% of the global economy? And when you overlay on that Zoomanomics, it became quite a major priority to do that. So that's why we could have just had S&P 500 index and said, okay, fine, we'll do that. And that wouldn't have really been much interest to anybody. Instead of that, what we did was we overlaid the Warren Buffett principles, and they are invest as though you're going to hold the stock forever. So every single share in this portfolio has been purchased as though it was owned forever. I just want to see if you can. There we go. We'll look at some of our sales. We've been going for over 4 years, and as you can see, we've got 7 stocks that we have sold in those 4 years. So buy them. You buy into them on the belief that if the stock market were closed for 5 years, you would be quite happy owning that share. But if circumstances change, if there is a structural change in the situation for the company that you've bought into, as in each of these there was, and we can go through them if you want, then you need to get out of that company and reallocate the money somewhere else. But it's hardly trading. In 4 years, or over 4 years, 50 months, we have, including up until today, we've sold 6 shares. So I mean, that's really one every 8 months or so. So it gives you an understanding that we are going according to the Buffett principles. So it's somewhere between index funds for the know-nothing investor and the trader who would have thought 6 changes to the portfolio in 4 years is like, you can't actually credit something like that. That's not trading, but that's what we do. So we try and find stock select or pick stocks that we think can outperform the index funds. And as it happens, some of them do, some of them don't. The trick to all of this is to keep your eye on the shares that you hold, and when circumstances change, like I went into some detail about Alphabet, or the belief that I have that circumstances have changed there, that is when you need to change your mind on the share as well. You don't mechanistically say, we made 100%, so now we dump it. Or we made 5%, and let's quickly take our profits. If you look at Metro Bank, which is the 4th one on the list there, we sold that in June 2018 at £32 per share. It's a UK bank. It had done nothing in 2 years. That wasn't the reason we sold it. The reason we sold it was because there was a scandal that was developing there. The chief executive, or the founder of the company, was shown to have given his wife contracts which hadn't been properly disclosed. On the basis that there's never just one cockroach in the kitchen, we decided to sell. it maintained that level for a while, but as you look over to the right-hand side, it's at £14.40 per share. Why? Well, in the last month, in fact, in the last week, Metro Bank announced that it had been not actually allocating the correct amount of reserves that it should have on its asset base, because it has been overstating the quality of its assets. And that came as a huge shock. It knocked the share price down again. It had already gone down to about £20. Now it's at £14.50. And as a consequence of that, it's 54% lower than where we sold out. It doesn't always work that way. As you can see, Tesla's actually gone up since we sold out. But the reason we sold out of Tesla was because Elon Musk was just completely misbehaving himself in the conference call, that he essentially told investors he doesn't need them. He'll do things his own way, which was really stupid because he needs to borrow money. His whole company's losing billions a year. He needs to go back to investors all the time and keep funding his dreams. It looks like things are doing better now at Tesla. They brought in a new chairman. They brought in new directors, including Larry Ellison. But even so, Tesla's very high risk. That 297 that's trading at now, it was 350 2 weeks ago. So I believe you should try and sleep well at night. And if you have that kind of volatility in a stock, it's probably not a good idea to be invested in it if you don't have nerves of steel.
Excellent, thanks, Alec. Gerard just picked up on your Koos interview. The suggestion, and at the end of the day, he spoke about the next big thing might be biological sciences or something. He says, will that not maybe involve the big tech companies such as Google?
Maybe, but maybe not. It was quite interesting, that, wasn't it? I asked Koos at the end of the interview, and he's phenomenal. He's had 2 home runs, if you think of it. He went to, I think it was Columbia University in the United States as a young man, and had the good fortune to be exposed there to this concept called satellite television. Came back to South Africa and managed to motivate a license being granted by the old apartheid government to the 4 newspaper groups. So that the 2 anti-government English-speaking newspaper groups, which was back then Argus Group and what was then SAN, South African Associated Newspapers, and they are today the independent newspapers and TISA Black Star, and the 2 Afrikaans newspaper groups, which was the old Persco and Naspers, they were both pretty sleepy newspaper companies. And Koos Bekker been motivated for the 4 groups to fund something called Mnet. And Mnet has developed into MultiChoice, which has been a phenomenal success. Then in 1990, around 98, 99, he got the internet long before anybody else. I remember at the time, it was quite extraordinary because you had this very successful, in those stages, Mnet and MultiChoice was really pumping business that Bekker was the one who believed in it, and he bought out the shares of the other newspaper groups progressively. And he then said, well, that's fine, but actually we need to be investing and spending a lot of money and borrowing money and investing into the internet, because that's the next big thing. And then he went off all around the world. He and the late Antoine Roux had this idea of, they called it throwing mud at the wall strategy, and hoping some of it stuck. And where their courage was reflected was that they just dropped $80 million. Now remember, this is all borrowed money from a very small, relatively speaking anyway, newspaper company with a satellite TV operation in Cape Town. They just dropped $80 million on the biggest Chinese internet service provider back in the late 90s. And at that time, they took another $30 million bet on a little company of 30 people in Hong Kong called Tencent. Now we know Tencent is today, I think it was certainly one of the top 10 internet companies on earth. And of course, it's completely transformed the Naspers story. And Naspers has, its 10 cents stake is worth something like 130% of the current Naspers share price. So Koos Bekker got it right twice. And in the interview, I asked him, I said, what are you going for now? And remember, this is a guy who thinks so differently. He took a year off for a sabbatical to just travel around the world. I saw him during his sabbatical, actually, in Davos. He came to Davos just to listen and to go, and he visited all over the place. He goes to China maybe 4 times a year, 5 times a year, and just to listen, to see what are the trends. And when he says to you he thinks it's going to be in the biological sciences, I think with his track record, you probably got to listen very carefully. Does it mean that Google and Apple and these guys are going to have the advantage? Maybe, but maybe not, because there are many, many bright people in the world, and they don't all work in those labs. Also, the bigger you get, the more difficult it is to make these breakthroughs. We often talk in our business, talking about the fact that the person who invented the light bulb wasn't a candlestick maker. So we've got to think differently about the media business, because our version of the light bulb, and the media business is really searching for it, won't come out of something that is obvious. And hence what Koos Bekker said about the biological side. I think it's time for us to start looking more and understanding more. I spoke to 2 people in Davos who are scientists, 2 of the premier or the leading scientists in the world on aging and healthy aging. And they talk, again, I'd urge you to go and listen to those interviews. It's a whole science on its own that academia is busy with, and they're part of the European Research Council, who what they do is they give these scientists that they carefully select a grant that gives them 5 years to just be curious and go and do anything they want to. Now, you're not going to that's not going to happen in Google. In Google, they might give you 20% of your time to go and do something that you want to, but the other 80% is pretty disciplined, and you're likely to find that the breakthrough, it could come from Google, but it's more likely to come from somebody who's just been told to be curious. So there's lots of these developments, and it's a fascinating world that we live in, and one where we've just got to keep our eyes open.
Thanks, Alec. I know you need some time to go through your sort of additions to the portfolio, but I've got a couple more questions if you want to touch on them.
Sure.
Just quickly from Hannes, he wants to know, will Apple come back?
Yeah, it's a very interesting question. It has been occupying my thoughts a lot. I was thinking long and hard about it. I really like IBM's recovery, and I think Ginny Rometty the promise is now starting to come back in that business. And you might recall that you can see there that we sold IBM when Buffett dropped out. We followed him in May 2017 at 152. It got down to about $110. It's now starting to pick up again. And I thought this time, ahead of this webinar, maybe it's time to swap from Apple back into IBM. That was what was going through my head. And it might still be a call next month or the months thereafter. I'm looking at both of the companies very carefully. I still don't think, though, that Apple's expensive. When you have a look at the share price in terms of its earnings and in terms of the free cash flow that it's generating, it's not expensive. And I think you're talking about a PE, price to earnings ratio, about 12 or 13. It's not like you need to grow 30% there to justify the current share price. And the second thing is that there still hasn't been the promise or the fulfillment of the promise from the potential of the ecosystem. And the Apple ecosystem is vast. I've personally discovered Windows 10, and I'm very impressed with Windows 10, but that's only because I've never played with anything barring Apple for literally 20 years. And to me, from where Microsoft was 20 years ago to where it is today, it's been massive improvement. So maybe it's only right that someone like me would be surprised at at how close to or even better than Apple the Windows system is. But most Apple fans are like me. They have Apple phones. They go onto iTunes. They're in the ecosystem. There is a billion devices out there, and they haven't really started making the kind of returns out of that yet that you can expect. Tim Cook, incidentally, the chief executive of Apple, was at Davos this year. Very, very low profile. And that also shows you the difference. He wasn't on any panels. He wasn't interviewed by anybody. But I walked past him in the street. I couldn't believe it. You could recognize him. And then somebody who was with me said, "Did you see the name?" Because you have to all wear name badges. And there he was, CEO of Apple, walking around Davos. I think it was his first, certainly his first public visit there. He could have been in the background before. But that's the way they're at. They're very secretive. They're busy with interesting things. Driverless cars is another big story for Apple. The market seems to only be judging Apple on its iPhone. Can it come back? Almost certainly.
Thanks, Alec. Doe just has a follow-up on Google. He says he gets that fundamental motivation to exit the company, but he says, don't you still think there's upside in the next year or so?
There could be, and that's the beauty about investment, is that you just can't time it perfectly. You have to take a judgment call on the reasons why you bought into it in the first place. Do they still hold today? And the reasons that we bought into Google were that it really was cheap and it had a lot of runway ahead of it. It was cheap relative to the rate of growth that it was experiencing. It also needed a little bit of discipline, and you got that through Ruth Porritt, the financial director. When she came on board, it helped the Google share price a lot. Investors loved the fact that you had a strong hand on the tiller on the financial side, whereas the founders, Larry Page and Sergey Brin, were a little more profligate in their spending. So it's professionalized, but you have to ask yourself how much growth, because share prices like Google's share price at the moment are there because of an anticipation of a very rapid continued growth. And if that is not going to happen, then the market will adjust that stock's price. I'm more concerned on a fundamental issue here, which is to do with privacy, because Alphabet, the company, is still over 90% dependent on Google, which is it's over 90% dependent on online advertising. So if the online advertising field, it's like the U.S. Steel and it's like the Standard Oil of bygone years, or even the Microsoft in its time, they're just too dominant, and something has to happen. Now, as long as Trump's in the White House, the chances of that happening are maybe less than if the Democrats were in the White House. If you were to have more of a swing to the left, obviously there would be a more radical addressing of the monopolistic position or the duopolistic position that Google and Facebook have at the moment. And you overlay there the privacy issues. You just got to start thinking that the risks are higher. But will the share price go up in the next year? Who knows? It could. It could continue for as long as Trump is president. But at some point in time, somebody is going to start thinking differently about these issues. The Europeans already are, but I guess one has to see it happening in America before you really see an impact on the bottom line.
Thanks, Alec. Just a quick one from John. He wants to know if you have any views on cannabis shares. I know it's a big thing at the moment in the media.
No, I tell you what, sure, that's something that it needs a lot of analysis. I was talking to a South African friend from Cape Town who was telling me that one of the big cannabis companies is just about to make a huge deal in South Africa. So, which isn't surprising for medicinal cannabis. It surprises me that we haven't had a South African cannabis business coming out of where we are now. I think, well, certainly when I was growing up, Durban Poison was the best you could get in the world. It was known all over, even by the hippies in California. They quite liked Durban Poison. So it grows well in South Africa and is of high quality stuff. So I mean, I don't know, but if you think about it, if you could have bought cigarette shares when they first began, or if you could have bought Coca-Cola when it first started, you might have some kind of an indication of the size of an industry that is likely to be developing through cannabis into the future as more and more countries legalize it.
Excellent. Thanks, Alec. I've got no more questions at this point.
Yeah, and we've got just enough time to have a look at what we're doing. We are buying US banks. We are buying into two big American banks. There's a choice. I had a look at the exchange-traded funds, the US bank exchange-traded funds, after Brett Duncan. We discussed this, and Brett was saying to me, well, why don't you just get a banking ETF? The problem is the banking ETFs, when you look at them, have a very small exposure to the big US banks. And what is it? Why do I like this so much? Okay, well, let me tell you a little story. I was at dinner a little while ago with a very, very senior person. It was a informal dinner. Very senior person from a major European bank, and we were all asked to make predictions on what would happen in 2019. And his prediction was that the major US banks would continue to keep eating up market shares against their European rivals. And given that he was from one of these banks, it got me thinking. I then started doing some more research into it. And the more you read and investigate banking stocks generally, and particularly US banking stocks, the more you realize that these shares, by historic standards, are unbelievably cheap. In fact, there was a piece in Barron's last week to say they're unreasonably cheap. And if you go back to this one in particular, to JP Morgan, which is Jamie Dimon is the CEO and one of the great banks that's been around for a long time, and also makes a lot of its money out of investment banking. Its price to earnings ratio at the moment is 11.5 times. Its price to earnings ratio a year ago was 18 times. So it just gives you an idea that the profits have been going up, but the share price hasn't. It would have, of course, been really nice to have bought the shares under $100 a share, as you can see, with that decline from 110 at towards the end of last year and the beginning of this year. But that was before the quarterly results came out from JP Morgan, and it has improved. So that's the one stock we've bought. It's on a price to book of 1.4 times. Now, a company like this, a bank like this, should be trading at least double that level on a price to book. Price to sales 2.5 times. It can be significantly higher than that too. The market capitalization of this big, it's a big international group. It's 343 billion. It gives you a dividend yield of 3%, and that dividend looks supremely safe. So add it all together. The whole world is saying banks generally are cheap, but which banks are offering the best value? The American banks are just in a different league to the others. Of course, you could be saying, but why aren't you going for Goldman Sachs, which is sitting on a price to earnings ratio of 8? Well, Goldman Sachs has got a problem in Malaysia, which hasn't yet been factored into the share price. Well, it's been to a degree, but not completely. Goldman Sachs has set aside $500 million for legal fees there. The Malaysians want $7.5 billion. So that one MDB issue that's going on in Malaysia is something that keeps me away from the Goldman Sachs opportunity. The other, I decided to add 2 US banks into the portfolio. The other one that we've added is Morgan Stanley, and that's even cheaper. Morgan Stanley is sitting, and I've just given you in the last year the share price movement. It's on a price to earnings ratio of 9 times. It's half what the price to earnings ratio was a year ago. This is a company that generates an operating margin, operating profit margin of 22%. It's got 850 billion in assets. It's got a market cap of 75 billion US dollars. So it's big, but it's not a giant like JP Morgan. And it really just is cheap. So very well managed, very aggressive. They've rebuilt their balance sheets, these big American banks, after the global financial crisis 10 years ago. And at this level, it's the kind of stock, it's the kind of deal that Warren Buffett would do. With a 74 billion market cap, for him, it's a bit difficult for him to buy into a Morgan Stanley, but given the size of his portfolio. But for us, it's plenty big for us to be able to have that investment. And if the markets were closed for 5 years, and you came back in 5 years' time, I'm very confident, as I stand here, that both Morgan Stanley and JP Morgan are going to be worth more a lot more at that time. So we're buying in here on the basis of US banks having an advantage over their international rivals and likely to continue improving through it, and also on the basis that by historic standards, they're very cheap. And that's really a value proposition. The world has belonged to the momentum investors. The value investors have to have their day at some point in time. And I would think that these shares could give us a little bit of a bite there, particularly that we've got some cash now from the sale of the Google or the Alphabet stock.
Thanks, Eric. I think you've stunned the crowd into silence because there's no questions on the move into banks here. So I'm not sure.
Yeah, US banks are a particular slice, and these two are more investment banks. So that's also a slice there as well. The world is discounting them because of the trade war. But if the trade war does have a satisfactory conclusion, and you have to believe there's a lot of effort being made to do that, and also we always muddle through as a species. We always seem to finally get to the right kind of conclusion. There's no purchase for anybody to blow your feet off, as both the Chinese and the Americans have tended to do. So let's not. You can't really believe that we're going to go headlong into an Armageddon on the trade side and just slash the economic growth because you have one crazy guy trying to take on another crazy guy. Fortunately, the reality always does come home to roost, even though the negotiating tactics sometimes seem a little bit off the page.
Thanks, Alec. Just two questions off the back of that. Henny just wants to know, will you buy the two stocks over the 3 months as per usual? Yes. And Gail wants to know your thoughts. What would happen to the US banks if the dollar weakens?
Yeah, on the first one, yes, absolutely, Henny. Thanks for that. We will certainly be doing that. We bought the first 1/3 slug, and it will be continuing along that road into the future. So I think it was about $10,500 in our portfolio. There's going to be about $30,000 in each of them because we're sitting with $60,000 in the account now in cash, and so each of them we've made the first tranche of $10,500 purchase. The reason for that is because we want to take the timing of both the rand and the dollar out of the equation, and so actually we're hoping that the share price goes down in the next 2 months to give us an even better purchase price in. Would the US banks be hurt by a weakening of the US dollar? You know, Gail, coming from South Africa, we see huge volatility in our currency. Volatility in a currency, in the US currency, is like 5 or 10%. It's not the massive swings that we see from a South African perspective. So yes, it will have an impact depending on how the portfolio is structured, but it's unlikely, given the way that they've bolstered the balance sheet over the past 10 years. It's unlikely that if the dollar were to depreciate, that it's going to have a significant impact on this on the underlying. These are global banks now. They operate all over the world. They've got clients all over the world, and it's not just the United States that affects their profitability. So I wouldn't worry about that. Anyway, who knows?
Thanks.
Yeah.
Thanks. I think one more just before we go. Hannes wants to know, so with his Alphabet proceeds, would you look at obviously the US banks, or would you not look at something else within the portfolio that you currently have that offers value? He just wants to get your thoughts on where he should maybe look.
You know, Hannes, I'm really keen on US banks at the moment. Let's just look at that portfolio and we can go through it quickly. I'm really, really keen on US banks. I think that the value, the underperformance of value stocks for so long means that at some point in time that wheel has to turn. And it looks to me like the wheels, that everything's right for those value stocks in particular. If you start off by at the top of the portfolio, Amazon, it's still up 60% on a year ago. Let's not forget that. So although I love Amazon and I would blanch before thinking about selling it, given the way that the Amazonifying everything in reach, it seems, I wouldn't be selling the shares. But when you look at the upside from the current levels, you can't believe it's going to grow another 60% this year. Surely not. Alphabet, we've sorted out. Apple, it's got vulnerabilities at the moment. You know my thoughts on it, on the ecosystem, but it doesn't mean that that's a universal belief. Tencent's picked up very nicely recently. It's also just had an opening in China. The reason why it came under pressure was because of the video games. The Chinese government wants to get the kids to play video games less, so it's blocked. It put on hold the issuing of licensing, and Tencent missed out on the first two licenses that were issued after the suspension, but it's just got a whole bunch of licenses now, so it's back in the game. The S&P 500 index speaks for itself. Microsoft is quite fully valued at its current level. It's a fantastic company, and again, I wouldn't think of selling it, but it's fairly well valued. Similarly, Berkshire, Alibaba in China, and Adobe again is quite fully valued. So when I look at all of this, if I was worried about any of these shares being hugely overpriced, given their prospects, then we would have been talking about that. But actually, to reallocate that funds, to reinvest those funds within the portfolio, I think it would be a little bit like putting all your money into the South African stock market. There are so many opportunities outside of South Africa, in the same way as there are great opportunities outside this portfolio. I'm not selling any of these shares until or unless there were some kind of a structural change, as appears to have happened now with Alphabet. But by the same token, let's look outside. And to me, if you take a 3-year view, US banks, they just look so cheap at the moment, and they probably will outperform most of these stocks in this portfolio.
Thanks, Zach. Just on the two banks, Evan wants to know, if you could only have one, which one would you choose? Probably of the JP Morgan and Morgan Stanley, sorry.
No, it's a bit dangerous that, I mean, even just going back to two, I also looked at Wells Fargo and Bank of America. Those were the four. So I would much rather say two is perhaps a little risky. I would rather, if I only had a limited amount of money to spend, I would rather try and spread that even more widely if I was worried about diversification. So sorry, I'm not going to answer that. Of the two, Morgan Stanley is the cheaper, if you like. It's on a 9 PE as against an 11 PE on JP Morgan. But I'd urge you to buy both.
Excellent. Thanks, Alec. I think we've got to leave it there, but I know we'll be back again same time tomorrow with your Davos trip.
Yes, and that's going to be quite an interesting one. It's the first time we're doing a webinar after Davos, again, for the premium subscribers. We've also got another webinar for premium subscribers on the 20th of February. Make a note of that, because that is budget day. So the day I'll be in lockup on budget from 6 a.m. And by the time Tito Mboweni starts speaking, we'll have everything up on BizNews. And then that evening, we're going to have a budget wrap up. So everybody else will be going to their breakfast the next day. And that evening, you already know everything that matters. Well, I hope to do that anyway on budget day. So make a note of that. But tomorrow is feedback from Davos. I'm busy going through my notes and the interviews I had and the off the record chats and the on the record chats. So we'll have a good chat, a good discussion tomorrow, which primarily will be driven by questions. So please do join us same time tomorrow, lunchtime tomorrow, for the Davos chat. And Stu, where do we register for that?
So Alec, I'll put a link into tomorrow morning's newsletter. Let me just see. I could get one up quickly now, but I'm not sure if. Let me just get it up. I'll put it onto the chat quickly. That'll help, I think.
Okay, that's probably a good idea, because it is going to be an interesting conversation tomorrow. And then, of course, I'm going to be doing a roadshow as per always. Every year after Davos, we do 3 cities: Joburg, Durban, Cape Town. This year we've also got Pietermaritzburg, and I know the Maritzburg Chamber of Commerce were telling me there's already 120 people have booked in Maritzburg. There are some tickets still available on Eventbrite, and of course Standard Bank are sponsoring the others in the other 3 big centers, and those dates are also on BizNews as well. That's in the middle of the month. I know Cape Town's on the 18th, Durban's on the 14th, and Johannesburg's on the 21st. So we'll have, and that's in person. So please try and come along and come and say hi, shake the hand, and maybe have a little chat. I look forward to that as well. So as you can see, quite a lot of public work to be done over the next little while. And then, of course, one can get back into the exciting stuff that we do on a day-to-day basis at BizNews. So, Stu, have you managed to track it down? Oh, there it is, Davos webinar version link. So that's for tomorrow. Easy enough to see in the chat box. Let's go and click there. You have to register, please. You get it as part of your premium subscription, but you need to register, as you know, for attendance here. You need to register to actually participate.
Excellent. Thanks a lot, Alec. I think it's been a great 1-hour conversation.
It's my absolute pleasure, and it's always nice when you've got an annualized return of 27% on a portfolio. But as I've said before, please don't go and project that because that's unusual. As much as we love Mr. Bezos, we can't expect him to be able to deliver another 400% in the next 4 years. Although, who knows? We never know. Thanks again. It's been my pleasure. Look forward to being back in your company for the Davos webinar tomorrow.